Timal Maru with us, and along with CA Timal Maru, I welcome CA Priti Savla and CA Shantilalji Kochar, along with all the other delegates. Before we start, as usual, I will chant. Please start along with me. Naukar Mahamantra. Om Namo Arihantanam. Om Namo Siddhanam. Om Namo Ayaryanam. Om Namo Vajjayanam. Namo Loi Savasahunam. Eso Pancha Namokaro. Sabva Pava Panasano. Manglanancha Savesim. Padamam Havai Mangalam. With the blessings of Naukar Mantra, I welcome all the members for this knowledge session of JCAF and with Shantilalji Kochar, JCAF Apex President, to address the gathering and start the session.
Jai Jinan to everyone. On this fourth lecture series of the JCAF, Embrace the Change in the JCAF. I welcome you all, especially Pritiben Savla, who is chairing this session today, and our Timal Maru, who will be the speaker for the subject recent changes in companies' rules and company audit and accounting auditors' rules recently, which has been changed, which is very important, and everybody should know what are the changes before signing the audit report. So I welcome you all the delegates, those who have joined the session, and once again, thank you very much for joining. Thank you.
Thank you, sir. Friends, today we have with us an excellent chairperson and chartered accountant and a central council member. Along with that central council member, of course, at JCAF, she does not need any introduction. In fact, in the entire WIRC, she does not need any introduction. But as a matter of formal working, I'm just briefing all of you what she has done till now. After becoming graduate from Bombay University in the year 1997, she became chartered accountant in the year 2000. From there on, she has been practicing chartered accountant and held, in terms of education, she has held different degrees as well. Like she has also learned insolvency. She has been insolvency professional from the year 2017. She's learned entrepreneurship management from Indian School of Business in the year 2014. She's been a DISA in the year 2004 and also completed certificate course on forensic accounting and fraud detection in the year 2015. So wide range of knowledge, and along with that, she's now independent director at multiple companies. To name a few: Aarti Industries, Aarti Drugs, ITI Mutual Funds, IRB Infrastructure, and along with that, she's also member of Audit and Remuneration CSR committees of ICI, as well as she's now, along with being CCM member, she is vice chairperson of Sustainability Reporting and Standard Board of Corporate Laws and Corporate Governance Committee. She is member Executive Committee Disciplinary Bench, right? And we all know she's been chairperson of our WIRC before the COVID-19-20. What a year it was. And it was one of the best year that I have witnessed in the entire WIRC arena. And with those few words, I now request CA Priti Savla to address the gathering as chairperson for the session. Priti Ben.
Thank you, Puneet Bhai, for such a wonderful introduction. It is, if we admire some person and if we give introduction, it is always high what we can speak and what you have spoken. So I really thank you for giving such a wonderful introduction. And Jai Jinendra to all of you, Shantilalji Kochar, the Apex JCF President, the speaker, CA Timal Maru, Hiral Shah, with whom I was coordinating, various senior members and my dear friends, I really thank you, JCF, for giving me this opportunity to chair the session and share some of my experiences of what I have received recently as a vice chairperson of corporate law and corporate governance committee specifically, because this is a very relevant issues which we will be discussing now and which I will be sharing with all of you. Recently, there is one company law committee under the chairmanship of Mr. Uday Kotak. And there are 10 members of this committee, and two of our past presidents of ICI are also member of this committee, has come out with a report, and that report speaks a lot about this company audits also. Why I'm taking, because this is relevant to today's subject, and as a chairperson of this session, I thought it is relevant to all of you, because the what opportunities and what issues we'll face because of this company law report, we will see that. The comments which we have to give, and we had a 3 roundtable discussions on this. We have invited various members to participate in discussion what comments should respond to this company law committee report. 6th May was the last date, and today we had a long, very long meeting of our committee, and we have finalized it and will be submitting by tomorrow or by 6th. So one of the issues is about the joint auditors, and this committee report says above the companies, listed companies above certain limit should have, no, even non-listed companies also should have a mandatory joint audits, and which is a very welcome provision for all the small and medium practitioners. So if we have an excellent team, you will get lot of opportunity once this will pass it. Again, they are becoming more strengthening, more NAFRA. So now there at present, if there are any issues or if the members is proven as a guilty, then the punishment is given by under our ICI only, under the disciplinary actions. But now the NAFRA is also proposing to have a penal consequences, and which we have requested, we are responding to them, that there can not be multiple penal consequences or any of the member. So since this is already been actually penal consequences are there under ICI disciplinary mechanism only, then the member should not be punished separately under NAFRA also for the same issue or for the same problem. So there are, like, relating to audit, these are certain things. There are various other things also which I'm not dealing with, but this is the thing which recently we are doing under corporate law committee. Further, as again, I am also part of SRSB, Sustainability Reporting Standard Board. So here, friends, now this CSR reporting at the calculation that 2% and a mandatory spending of these expenses is also becoming mandatory from 1/4/2022, right? Timal Bhai is a speaker. Earlier, why I'm telling it is becoming mandatory now at 1/4/21, not 22, correct, Timal Bhai? So 1/4/21, this is becoming mandatory to spend as per Schedule 7 of the Companies Act. And I'm sure Mr. Timal Maru is going to cover all these things, but just I'm briefing it why it is earlier also this proposal has come, and this section has speaking to have a mandatory spending. But now if it is not spent, the penal consequences are there, penalties are specified in it. So now the companies will have to spend it mandatory, because under otherwise earlier, before 1/4/21, there were no penal consequences. So these things. So again, the as a chartered accountant, as a members, we have a lot of opportunities in this CSR also. And for 1,000 top 1,000 listed companies with their market cap, this BRSR, Business Reporting Standards, Business Responsibility standards as per the SEBI guidelines, which are already there. Institute has already guidance note. They are revising the guidance note under SRSB. So this is becoming mandatory for ESG reporting also, that is sustainability reporting from 1/4/22. So now at present it is mandatory for only top 1000 listed companies. However, going onwards, it will be becoming applicable to other companies also, because world over this ESG and sustainability is the main area of consideration right now. So friends, keep all your things and put all these new opportunities what all are coming. So keep track of all these things and ensure that we are able to capture and grab these opportunities. Again, friends, today what Timal Bhai is going to cover is about what are the key amendments in Companies Act 2013 and the rules, along with the changes, certain changes which have also been there in Schedule 3 and the CARO. So main the CARO, this changes is CARO 2020. It was supposed to be applicable in the from previous year, but now it has been made applicable from current year. So if I have gone through and if I see there are 50 changes are there, 50 changes, and that earlier only 22 clauses, and the only one clause is the older clauses which was there, which were removed, and that also has come back. Again, I feel that friends, how why so much strengthening of to these companies, so many reportings are becoming applicable. So the MC ministry and the government is wanting that a lot of independence should be there, and reporting should be strengthened, ki there are no loopholes in this. So we have to take care. Again, the onus is on the auditor, because if anything happens wrong, the first person who is blamed is the auditor, ki auditor ne kya kiya. So then always eyes is on the auditor instead of the management. So with this 50 clauses, this we have to ensure that this fixed asset register and various registers, because in private limited companies, friends, it is very difficult that they are maintaining all these things. But then it becomes, because now everything, even our disciplinary is also becoming strength. Early, presently what we have disciplinary committees, our own member, president or vice president of ICI is only the presiding officer. But now with 3 members and presiding officer also being the government nominee, the things are becoming very strengthened. So if we are not checking, and if the companies are not maintaining any single register or minutes, so then, again, we are only the question. So we have to ensure that all these things. And again, if we see the NOCLAR, at present, we have extended the applicability of NOCLAR by 6 months. But if this NOCLAR, what is this NOCLAR? Means right now we are only signing the CARO report or audit report. But the NOCLAR says that whatever laws, rules and regulations are applicable to the company. So there are, I am on the board of some listed company, and there some 1800 laws, rules and regulations like Pollution Control Act and the Labor Law and what all Shop and Establishment Act and all those rules, acts are applicable. So as an auditor, it is the responsibility of the auditor to sign that the company has complied with all these laws, rules and regulations, and the time limit what we are doing audit, and what in fees, what in which the members are doing audit. It becomes really difficult, and sometimes I feel impossible to comply with all these things. So with even the CARO coming, new CARO, the double time what we are spending now, it will be there. So friends, we have to also see what fees we are charging now, with this new CARO and all. So all these things are there. So we have to keep regular track on what new things are happening, what is applicable to the auditor. Lot of materials are available on the institute website, but with the JCAF organizing such a wonderful program for the members, I am sure it will really add value to their knowledge with the practical tips what the speakers are giving. And I really appreciate the activities of JCAF for reaching out to the members all round the year, whatever may be, but JCF session is always there. So excellent work, Kochar ji, Puneet bhai, Hiral bhai, and all the dignitaries, Amrit ji, and all the dignitaries. I once again appreciate all your efforts, and we are regularly in touch. And friends, with these opening remarks, I give the charge to CA Timal Maru, who will be going in detail through the proposals of all this CARO and Schedule 3 and the new amendments which has which have come in Companies Act. So thank you very much.
Thank you, Pratibhen. Thank you for giving the updates as what is happening at Delhi, at the corporate level, at the NAFRA level, and also suggesting our members and putting an onus on Timal bhai as well, that what fees should be charged. So so much regulations coming in. So Timal bhai, I'm sure you would give us some idea that how much fees should be increased, or there is no question of decrease. You would give us along with the other updates that what fees we should be charging. Nevertheless, thank you, Pratibhen, for your wonderful opening remarks, and we always look forward for your contribution and for your inputs on such an important topics. And I'm sure with our representative of the entire Western India Regional Council, which is not only representing entire 20 to 25% of the taxation companies, the members who are handling it, we should be able to put, with your involvement, we should be able to put the right framework in place to allow more and more members to grow. And fantastic updates that you have shared in terms of joint audits and the other aspects. Thank you, Pratibhen, once again. Friends, now before Timal bhai starts, I have a pleasant task of giving a brief introduction for Timal bhai. He's been a member of Chartered Account, our ICI, for last 23 years. Has been practicing as a partner at MS Sridhar and Associates, which are having offices at Delhi, Bangalore, and all the other than in Bombay. He's been also Sridhar and Associates is also having offices at Singapore, Mauritius, and Hong Kong. That is also partner of company and branches at Kota and Bhopal. Friends, as far as today's topic is concerned, he has a long experience in handling statutory audit under Indian GAAP, GAS, EU GAAP, and EU GAS. So these are all the critical things which are required for attending or deliberating on a complex subject like this, what we are having today, the CARO reporting. Timal bhai has also handled multiple statutory internal and management audits for listed, unlisted, and mid-sized corporates. He has also been part or handled valuation, due diligence, fraud investigation, restatements of financial statements, and other things. Besides, he has also been experienced in providing opinion on various accounting matters which are related to company law. So this is very critical for what we are going to learn today. Friends, he has also presented papers on recent amendments in companies accounts rules and companies audit and auditors rules for the year 21-22 in the national program organized by Corporate Law and Governance Committee of ICI. So we've a regular speaker. That's what he has been, and he's been also contributor to the illustrative Ind AS financial statements published by WIRC of ICI, and also contributor to anthology and Ind AS notes disclosure publication issued by WIRC of ICI. With such huge knowledge and deep learnings, I welcome CA Timal Maru for this session and would request him to take over the floor and address the August gathering. Thank you, Timal bhai, for joining and giving your valuable time, and please start the session.
Thank you, Punit bhai. I'm audible?
Yes, very much, sir.
Okay. Thank you. Before starting the session, I would like to thank the chairperson of the session, Ms. Preeti Savla, who is also a CSIM of this institute, President Shri Kocher Sahab, Mr. Hiro Shah, to whom I am regularly contacting for this program. Ms. Preeti Savla has already, in her opening remark, has stated what are the challenges we are which are facing if the new company law, the report issued by the new company law committee is come in the light. At the same time, she has also highlighted about the CSR things, Caro, Nokla, and all others, where as a statutory auditor, your roles and responsibility will be much multifold. On the lighter note, I think Mr. Punit bhai also discussed about the fees. I think we are all sailing in the same boat. So, if, no doubt, institute has some sort of the mechanism. They have some sort of fee structure they have proposed, which is voluntarily to be adopted. If we start adopting, then possibly we may come out of these issues. Now, coming to today's topic. Now, if you see the books which are here, now after clearing the chartered accountancy exams, we all feel कि एक बार हमने CA बन गए, so life is easy. Now, if you see the way in which the changes are coming in the Companies Act or GST or income tax, our lives are becoming miserable. And by every day and night, we have to start reading and updating ourselves. Can you confirm where my screen is visible?
Yes, sir, very much.
Okay. Now, see, if you see the changes which has come in the past couple of years is related to there is a question on the transparency, there is a question of the investor confidence. There is a question on the accountability and if you see the sizable NPS because of we could not give the early warning signs. All this in totally has forced government to come out with the strict rules and regulations for the auditors or maybe the companies. Now, in today's session, what we are going to cover is the key amendment relating to the Companies Act relating to accounts. Second is the Companies Accounting Standard Rule 2021, key changes in Schedule 3, key changes in CARO, Companies Audit and Amendment Rule 2021. So I will start with first thing is the key amendment in the Companies Act 2013. There is a change in the definition of the listed company. Earlier, as per the earlier definition, listed company means a company which has any of its securities listed on any recognized stock exchange. Now, which has been changed with effect from 1st April 2021. Now, what it says, following will not be considered as a listed company. One is the public company, which have not listed their equity shares, but have listed their non-convertible debt issued on private placement basis, non-convertible redeemable preference share issued on private placement basis, private companies which have listed their non-convertible debt securities on private placement basis. The idea is to have a different set of rules and regulation when any company is going for a public issue and when any company is going for the debt listing, because debt listing is the mandatory, sometimes the mandatory requirement by those who are investing in the company. Now we will see the implication of due to change in the definition, what will happen. Now, section 139(2), which deals with the rotation of auditor, will not be applicable in case if the company is not a listed company. Same way, internal financial control, or there will be a less penalty to a non-listed company compared to the listed company. Nevertheless, SEBI LOTR has not given any sort of relaxation for those debt listed company. Still, those companies required to carry out this quarterly result, the audited financial statement within the time frame of the 60 days, and there are some other disclosure which is mandatory. The amendment has also brought some changes in the definition of the small company. I would say not definition on the threshold limits, which was earlier in case of paid up capital was 50 lakhs, which has been now increased to 2 crores. In case of turnover, earlier the limit was 2 crores, now which has been extended to 20 crores. This is a very sizable relaxation is given to the number of companies. There were, after the amendment, there were reports around more than 2 lakhs to 3 lakhs companies would be benefited because of there is a change in the threshold limits. So once the implication would be once the company becomes a small company, the financial statement in financial statement cash flow is not required. In case of board meeting, only two board meeting is required instead of 4. CARO will not be applicable. Now we'll go to the next point. Now there are some changes which are sought for the by way of additional disclosure in the board report. We'll see what are those changes. Rule 85. The details of application made on proceeding pending under insolvency bankruptcy code is required to be disclosed. Further, the details of difference between the amount of valuation done at the time of one-time settlement, the valuation while taking loan from the banks and financial along with the reason thereof. So this has come, if you see the past history, in case of IBC company, where in most of the cases the settlements are happening at the range of 20% to 25%. So these central governments would like to understand what are the valuation was done when the company has taken a loan, and when the settlement is done under IBC, what is the valuation? So it is required to be disclosed. So when we are disclosing this criteria, on the basis of this criteria, we need to understand the requirement is on the basis of the loan taken from banks or financial institution. But if you see practically, the companies may be taking a loan from the other lender. So how to disclose the liability towards the other lenders? CARO 220 required disclosure for the default in the repayment of loan or others in interest thereon to any lenders. So if the board, the company is disclosing this sort of a disclosure in the board report, there would be an additional responsibility on the auditors by way of SA 560 subsequent event. If the transactions is happening after the balance sheet date, we have, as an auditor, we have to evaluate the SA 570 going concern. At the same time, there is a requirement under SA 720 where the auditor responsibility related to other information is required. So we have to be very careful once the company start disclosing the required disclosure in the audit in the director's report. Now, this maintenance books of accounts, if you see in the last couple of years, this matter is discussed at length at various forums. Now, what the MC or the central government wants, they wants every company which uses accounting software for maintaining books of accounts shall use only such accounting software which has a feature of recording audit trails or creating edit logs or ensuring audit trail cannot be disabled. this requirement will have a far-reaching impact on the way in which the books of accounts are maintained. However, this clause has been postponed till 1/4/2023. The central government has come out with the one more requirement for the unlisted company by way of a periodic financial result. So what, like the listed company, we are doing the quarterly result. So in this case also central government wants for the set of unlisted companies to prepare the separate set of financial result which has to be approved within the 30 days. However, this requirement is not yet prescribed. One more thing which I would like to emphasize on this is if you see the section is 129A. Overall, in all the Companies Act, which we have not seen any section with either A, B, C. This is the first time which is coming by way of A. I will go to the next point, the corporate social responsibility. Now, there was some set of rules which has pronounced. So, in case if in past we have paid excess amount on account of a CSR liability in excess of what was required. Now, henceforth we can set off those excess liability against the current year's liability. Question will come if in the current year, say in March 22, you are supposed to pay 2 crores as a CSRN, but instead of 2 crore, you have paid 2.5 crore. Now, if you want this additional 50 lakhs to be set off against my future liability, how to account? The accounting would be the such excess amount which has paid, which should be accounted and disclosed as the prepaid expenses. There is one more compliance has come for the CSR purpose, filing of form CSR 1 and filing of form CSR 2. Now CSR 1 has to be filed by the company whenever they want to do future transactions, but CSR 2, which deals with whatever amount is spent for the 2021, has to be informed to the MCA by way of filing CSR 2. The earlier due date of filing CSR 2 was March, now which has been extended to 31st May 2022. And this is just they have given certain relaxation in the number of days, which was earlier 15 days, now has been reduced to 7 days. This is the procedural part with respect to the filing of the special resolutions. Earlier, the exemptions was given to the only banks. Now, the exemption is extended to the NBFC housing companies also. Now, remuneration to non-executive director. This was pronounced, or this has come effective from the 18 March 2021. However, I am for this presentation I am covered because it was very less period in the past period, so a majority people are not aware. Now, what the new amendment sought is now independent director and non-executive director would be entitled for the remuneration in case of negative or the inadequate profits. The threshold limits are displayed on the screen. Now we'll move to the next topic, which is the Companies Accounting Standard Rules 2021. As everybody knows, either company has to follow either the Ind AS if those threshold limits are reached, or either you can follow the accounting standards. Earlier, we used to follow the accounting standard rules 2006. Now, this rule has been amended with effect from 1/4/2021. So each and every company who are coming under these threshold limits are required to follow the company's accounting standard rule 2021. So by notification or in the company's accounting standard rule 2021, the total accounting standard notified are As 1 to 5, A7, 9 and 29. A6 and 8 is omitted and A6 is clubbed with the AS10. So now AS10 is revised. We'll see what are the changes in the threshold limits. If you see, the small and medium sized company has to comply all the 5 requirements on the cumulative basis. One is the listing requirement. Now, if equity or debt securities are not, should not be listed or should not be in the process of listing, it should not be a bank, financial institution or insurance company. Turnover. Now, the changes come in this criteria. The earlier turnover requirement was 50 crore, which has been now extended to 250 crores. Borrowings. In addition to the turnover, the threshold limit in the borrowings also changed from earlier 10 crores to 50 crores. Now the relationship of holding subsidiary still continue. So in nutshell, there are changes in the criteria of the turnover and borrowing. By changes in the threshold limit, possibly there may be a more number of companies which would fall under the which would require to follow the company's accounting standard rules and as the SLC. Now the requirement, who can avail this SLC relaxations? So to avail the exemption or relaxation, company should fulfill criteria of SLC or for at least 2 consecutive accounting period. So possibly if you see in March 21 and March 22, in March 22, because of change in threshold limit, number of companies would have come in the bracket. However, those companies cannot use the exemption if they are not continuing with the SLC criteria for 2 years. So possibly all those companies would be in a position or would be entitled in March 23 only. Now, when the company is moving from SMC to non-SMC, so exemption or relaxation will not be applicable from the year in which the company becomes non-SMC. So figures of the corresponding previous period not required to be revised. So this is the welcome change. It was there in the past also. And disclosure in the notes to the financial statement that the company was SMC in the previous period and it had availed exemptions on the relaxation. So this note should be the part of the financial statement. All SMC who are enjoying the relaxation or benefit should mention in the financial statement. This is the unexplicit statement. The company is a small and SMC as defined in the general instruction in respect of accounting standard notified under the Companies Act. According, the company has complied with the accounting standard as applicable to small and medium-sized companies. So if you see overall the summary of the relaxation in the compliance with accounting standard is the AS3 is not required to be followed. However, the relaxation would not be applicable if the company is other than a small company. The relaxation is with respect to AS17 segment reporting. There are partial exemption with respect to the AS15 employees benefit, lease, EPAs 28 and 29. So in nutshell, if you go the accounting standard, which is to be followed by the various entities in India are bucketed in the 4 categories. One is the Ind AS financial, which is applicable to the corporate. Accounting standard, which is applicable to the company other than SMC company. Accounting standard is which is applicable to SMC companies. Within that, there are sub 3 groups are there. The SMC can take a full exemption or second partial exemption or no exemption. And third category, which is applicable to the non-company, where the ICAI notified standards in the category of level 1, 2, 3, 4 would be applicable. Now, we will move to the main topic now. As we are meeting to discuss the changes in Schedule 3, changes in CARO, and changes in the main report, which are impacting on the preparation of the financial statement for the year ended March 22, and based on the financial statement, the challenges faced by the auditor for issuing the report. Just to give a background, changes in Schedule 3 was notified by GSR 207 dated 24th March 2021. Now, which was applicable for the with effect from 1st April 2021. There was some sort of the confusion, because once we say applicable from with effect from 1 April 2021 and the applicable from with effect for the financial years beginning from 1 April 21, there are two different things. So, Institute by way of a guidance note has clarified the changes would be applicable for the financial year starting from 1/4/2021. Now, if you see a CARO, now if you earlier we used to follow CARO 2016/2016 and subsequently CARO 2020 was introduced. Now, due to the COVID implications, the application of the CARO 2020 was deferred. Now, ultimately, the changes proposed in CARO 2020 is applicable for the financial year starting from 1 April 2021. Same way, we are issuing a report under section main report, in which also under Rule 11E, there are some changes and there are some drastic changes which we have to understand, which in the subsequent slides we will discussing in detail about what are the changes. In short, the Schedule 3, if you bifurcate Schedule 3, there are three types, and Schedule 3 Division 1, Schedule 3 Division 2, and Schedule 3 Division 3. One is mostly applicable to companies whose net worth is less than 250 crores, or who I would say those who are a non-Ind AS company. Division 2 is applicable to the company who is following Ind AS, and Division 3 is specifically applicable to the NBFCs who are following the Ind AS. If you bifurcate the companies falling under the different division, what set of financial statement they are required to prepare. If you see Division 1, generally we used to, most of the cases we used to follow same balance sheet, statement of profit loss, cash flow, and notes comprising. In case of Division 2 and 3, in addition to what the Division 1 is required, the statement of changes in equity is there. In case of the profit and loss, we have to also companies also required to prepare the OC, other comprehensive income. Will little bit touch upon the applicability of CARO. If you see the compared to the 2016 and 2020, for the applicability there are no changes. So it is just for the sake of the disclosures. Now, what the changes which is brought in Schedule 1, 2, and 3. I have summarized what are the changes and what are the changes in the Division 1 Now, if you see there are changes with respect to the presentation in balance sheet. Now they've introduced a new concept of the promoter shareholding to be disclosed. Something on the utilization of borrowing, which if we recollect, we used to disclose under CARO 2013, but never such type of disclosures were required in the financial statement. So now by these changes, there are most of the changes which are brought, which are in which we have to report in CARO 22. But in the same disclosure is required to be disclosed in the Schedule 3 also. There are changes in the trade payable aging schedule. If you see in the past history up to the March 21, as the audit procedure, we would be doing the aging, but we have never disclosed those aging requirement in the notes to accounts or in the financial statements. Now, these changes require the aging of the trade payable. If you see on the asset side, same aging is required from the CWIP, intangible assets, trade receivables. Now, there are by for journal instruction, a lot of disclosures are coming, which are required to be disclosed in the notes to accounts, and in most of the cases, the corresponding reporting is also there. So all the line items will be discussing in detail in my subsequent slides. I have just highlighted what are the summary of key changes in the CARO with respect to PP, inventories, loans and advances, disputed statutory dues, undisclosed income. It's coming for first time. Then internal audit system has all come back. There are some disclosure with respect to the NBFC cash losses we used to disclose in, I think, up to 2013, and which has come back. Now we have to comment on the resignation on auditor, which will I will discuss in my subsequent slides. Material certainty, CSR, CFS. So, for the purpose of the understanding, there are certain changes which are there in the Schedule 3, and accordingly, we are also required to report in the CARO also. So for my presentation, I have bifurcated all the changes in these 4 buckets. So first bucket deals with the key changes in the Schedule 3 and related changes reporting required in CARO. Second bucket, we will be discussing key changes in the Schedule 3 and no corresponding change in CARO. Third bucket is only a changes in CARO, but no corresponding change in Schedule 3. And fourth bucket is the key changes in Schedule 3 and the related changes reporting requirement is the new report which is prescribed. Now we'll start with the key changes in the Schedule 3 and related changes reporting requirement in CARO. One note of caution is the auditor will have to ensure that there is no material discrepancies between the financial statement disclosure and his reporting under CARO. Please ensure it. Now we'll deal with the first, property, plant and equipment, disclosure of title deed of immovable property. At present also we are disclosing on the whether the title deeds are a title deed of immovable property is in the name of the company. Now same disclosure is required. We used to disclose in CARO. Now the same thing is required to be disclosed by companies in the notes to accounts by the where they will say the company shall provide. So company has to disclose the company details of immovable properties other than properties where the company is the lessee and the lease agreements are duly executed in favor of lease whose title deed are not held in the name of a company in the following format. So Schedule 3 has also prescribed the format. Now, if you see the way if you overall understand the changes earlier, some sort of acts were there. Subsequently, it is coming by way of rules. Now they are prescribing the detailing also. Okay, in the which format you have to report it. Second thing, if you see the format, so first line item is the relevant line item in the balance sheet, whether it's a PP, investment property, non-current asset for sale, or any sort of others. Descriptions of item of property, gross value, title deed in the name in the name of. So you have to specify whose name title deed is there. Although in case of the related party, so we have to additionally disclose whether title deed holder is a promoter, director, relative of a promoter, director, or employee of promoter, director. In addition to that, property held since which date, and more importantly, the reason for not being held in the name of company. Now, once the company start disclosing the reason, as an auditor, we need to verify the reason and accordingly take the cognizance of the same while doing the audit. Same corresponding reporting requirement is there in the CARO, and there also the format is prescribed. So we'll deal with the what are the key audit consideration is required when as the companies wants to disclose the title deed related disclosure in the notes to accounts, and what auditor has to follow while reporting in the CARO. There are certain challenges are there. If you see whether the agreement should be registered agreement, I think there is no clear-cut instruction, but generally we prefer there should be a registered agreement. Now, lease properties, if the agreement expired, then still require disclosures. In my opinion, yes. So third is whether the company is the leasee of the immovable property and the lease agreement are not duly executed in favor of the leasee, then appropriate. Even if the company is holding the property and the lease agreement is not executed, still the disclosures will come. Now we have to very clearly understand, if you see in the most of the group companies, properties of the group companies are used for running the business. Now, can we say these properties are used by the company without entering into a lease agreement? This is a very dicey situation, and on the basis of the individual on a fact basis, we have to understand whether what sort of the reporting is required, or we can educate the client to have the certain agreement in place so that this clause can be complied. Now, if you see the Schedule 3 reporting requirement, they are asking in the last, they are asking the in addition to PP, investment, non-current asset, and they are asking for the any other sort of property. Now, if you see what would come under the others. So there may be a case where building is considered as a plant and machinery. So in such cases also, those building is required to be reported here. Now questions will come. Now whether immovable properties presented in inventory would also be required to be reported. Answer is no. If you see the guidance note is also of the opinion of given the same thing. The immovable properties relating to inventories should not be reported. You would have seen the cases where the properties are coming by way of a business combination or acquisition by way of a merger or the demerger. So in such cases, it takes some time to change the name because the company has to comply with the stamp duty requirement, or there may be some local or state government or the local authorities requirement. So till that time the name is not transferred, the disclosure is required in this clause, in both the Schedule 3 also and CARO also. properties owned jointly with others. So possibly there would be cases where we are a joint owner and joint on property is not in the name of the company. So in such cases, also we are required to disclose the in the Schedule 3 also in CARO. Now, in case of change in the name, also we are facing the same issue. Till the time the name is not updated, it will be difficult to disclose. Now, with respect to the PP and intangible asset, there is one more additional disclosure. One more disclosure has come in Schedule 3. So, whenever the company is following the revaluation model, either a Division 1 company or Division 2 or 3 company, such property, plant and equipment or ROU are valued or revalued by the registered valuer as defined under Rule 2 of the Companies Act. If the revaluation is not done by the registered valuer, the same need to be disclosed in the notes to accounts. In addition to the revaluation, it talks about the in the Schedule 3, a reconciliation of the gross amount and net carrying amount of each class of asset at the beginning and the end of reporting is required. So they have specified what sort of the details are required. So all addition, disposal, acquisition through business combination. What are the amount of changes due to revaluation if the change is 10% or more in the aggregate of the net carrying value of each class of property? Here they are putting or they are giving a cap of 10%, but if you refer the account audit, the index or accounting standard, once we do a revaluations, the 10% criteria would not be applicable. We have to disclose even for the lesser than the 10%. Same sort of a disclosure with respect to a revaluation is required in case of the intangible assets, like addition, disposal, 10% criteria. However, your attention is drawn. If you see the para 3 of case 26, which does not permit revaluation model for intangible assets. So ideally, this would revaluation would not, the disclosure for intangible asset will not come for those companies who are following the Division 1. Further, there seems to be a little bit typographic or error, as what they are saying, the related depreciation need to be disclosed, but in case of the intangible assets, amortization is required. So it seems to be a typographical error, so we can use this amortization only. In line with the revaluation requirement in Schedule 3, CARO is also required. The auditor is required to report whether the company has revalued its property, plant, equipment, including right of use or intangible or both during the year. If so, whether revaluation is based on. So this is the statement of fact. If it is done by the registered valuer, accordingly the reporting will come here. Now, just key consideration as per the ICA guidance note, the clause is applicable where the company adopts the revaluation model. But however, if you see the business combination or the merger, at the time of acquisition, the company is required to follow the fair value under the index. So fair value would not be treated as the revaluation model. Now, this is just a food for thought. Now, when we discuss about the revaluations, whether it's always required to be done by the external valuer or the company has the option to do internal valuations. Now, if it is done by the external valuer, definitely it has to be done by the registered valuer, and in the registered valuer, there are different valuers for the machineries and there are different valuers for the land and buildings. So, auditor has to understand and check the necessary documentation to confirm whether the value is a registered value as per the rules. Further, this revaluation is required under the Index 113 fair valuation. So please ensure the requirement of Index 113 is also complied. Now, as we discussed the internal valuation, if we need the order, the order does not seem to mandate any company you have to do only external valuations. So possibly they can do internal valuations. So in such cases, since the valuation is done by the management, so as an auditor would require more degree of professional skepticism to understand what are the assumptions are considered for revising the values. With respect to the details of Benami property, now if you see, the company is required to disclose whether they are holding any Benami property, and at the same time some sort of the disclosures from point A to G is required. So this is come for the first time. So if we come to a knowledge, if companies come into a knowledge or auditor come into a knowledge, a company is holding any Benami property, the disclosure would be required in the Schedule 3, as per the Schedule 3, and accordingly same disclosure would be reporting requirement is there under the CARO also. Only the food for thought is the reporting under this clause is limited to adequacy of disclosure in the financial statement and to cases where proceedings are initiated with the company being treated as a Benami bank. The reporting is not applicable when the notice is received by the company as a beneficial owner. So they are bifurcating between the holders and beneficial owners. So if the company is a beneficial owner, the disclosure under Schedule 3 or the reporting under CARO would not be required. So if we come to a conclusion, either management or promoter or the directors or the auditors, then the company is holding the Benami property. So what would be the key consideration which we have to verify? So from audit procedure, possibly we can review the board minutes or the audit committee to understand what stance is taken by the company. We can verify or scrutinize the legal expenses to understand when legal expenditures are incurred with respect to Benami property. We can review the listing of the pending litigations, obtaining management representation or independent confirmation from the legal counsel. The reporting required by the auditor of the company holding any Benami property, but not as the auditor of the company, which I think which we have discussed. If you are holding a property, then only reporting is required, not as a beneficial owner. Now, this is the interesting one. Inventory disclosures. When the company has borrowing from banks or financial institution on the basis of security of current asset, it shall disclose the following: whether the quarterly returns or statement of current asset filed by the company with banks or financial are in agreement with the books of account, if no summary of reconciliation. See, previously the company used to take the borrowings and they used to submit the whatever monthly or quarterly returns, but Schedule 3 never required the disclosure of the same. Now, because of if you see what sort of frauds are going in the banking industries, the government thought, let's this sort of disclosure comes by way of a disclosure in notes to accounts, and let auditor report on the same. Here, the reporting is required only if there is a discrepancies. And the ICA guidance note on Schedule 3, Division 1, 2, 3 all are given an illustrative format of disclosure in case of a discrepancies. On the basis, in the line of the Schedule 3 disclosure, auditor is also required under the CARO to report whether during any point of time during the company has been sanctioned working capital limit in excess of 5 crores. So the difference between what Schedule 3 requires and here is the as an auditor, I'm required to report only if the excess of 5 crores, whereas there are no some threshold limit for the disclosure in the account notes to accounts or in the schedule 3. So while reporting in the CARO, I need to understand I have to report only if the sanction working limit is in excess of 5 crores. So we'll see the what are the reporting while reporting here, what are the things which as an auditor should consider is the now the questions will come this limit is with respect to a single bank or the consolidated. So ideally, if the limit against current asset of all banks and financial institutions in aggregate should be considered to arrive at 5 crores. Second questions will come whether it's sanction limit or the utilized limit. If we read the wording of the reporting requirement, talks about the sanction limits. So we have to consider only a sanction limit. So what will happen if we have a sanction limit versus a non suppose I would have sanctioned a loan of 6 crore, but my drawdown is still a 1 crore. So in such cases also the reporting will trigger. Now, but while calculating this 5 crore, we have to consider both fund-based facility and non-fund. So both has to be aggregated to arrive at the limit of 5 crores. Now, questions are coming if the sanction limit is less than 5 crore, but amount utilized is more than 5 crore due to the temporary overdrawing. Then in such cases, whether the reporting is required. If you read the requirement is the sanction limit is 5 crore. Maybe possibly because of the financial crunches, the borrower is unable to pay and the actual limit outstanding limit is exceeding the 5 crore. However, the sanction limit is less than 5 crore. So in such cases, no reporting is required. So if we read the reporting requirement specifically deals ask if my loan is against my current assets, if the loans are taken or against my immovable property, then reporting is not required. That's one thing. Second, if the loans are unsecured, then it is the out of the reporting purview. On the basis of our understanding when we are dealing with these such clauses, I have highlighted two practical issues. Now, one, say a company whose financial for the March 21 or were finalized in September 21, and in those financial certain data which were outstanding in March 21, either were provided or written off. So if we say on March 31, originally my 50 crore debtors were outstanding, and when I'm moving for the finalization and on the basis of the information available, management and auditor come to a conclusion, okay, either provision is required or write-off is required. Say this 50 crore is reduced to 30 crores. Now in between, since the financials are finalized in September 21, but the company is required to submit a quarterly statement of June also. So in those statements, such adjustments are not considered. And say 50 crores continue as a 50 crore, and on the basis of the 50 crores, the company is drawing the limits. So when we are all doing the audit or the company is reporting for the quarter ended March 21 for the financial year 21-22, the figures as per book will not match with the figures what is submitted to the bank. So in such cases, such discrepancies with the explanation is required to be disclosed in the financial statement. Okay, what are the facts of the cases and why there is a deviations? We'll go to the practical issues which we are facing. Additional funding available based on inflated figures or wrong aging, which are not matching the mix of books. If you see an majority of the small companies, or where the systems are not strong, just on the basis, just they submit the report to the bank for availing the limits. Sometimes this sort of activities are done with the intention, and sometimes without intention also. Sometimes what is when the things are happening with intention, say I have as per the books, I have only a stock of 10 crores and I'm submitting a stock statement of 50 crores. So it is inflated figures which are submitted to the bank for availing the loan. So what will happen now, if as an auditor you come to a conclusion while reviewing this quarterly statement, the gap between the book dates as per book statement, as per the books, and as per the what they submitted is a sizable, possibly you start thinking on the fraud angle. And once we start thinking on the fraud angle, please also consider the reporting requirement under section 143.12. Now, in the subsequent slide, we will discuss on 143.12 additional reporting requirement has come in the CARO. There may be a governance issue, impact on IFC, and at the most, we may consider or evaluate the modification of opinion as required by in SA 705. Now, loans and advances without specifying the terms of repayment or disclosure. If you see in most of the companies where the loans are given to the related parties, either if you say payable on demand, or there are no terms specified. Now the company or central government, by way of amendment in Schedule 3, has required company to disclose all the loans. To all loans and advances in the nature of loans are granted to promoter, director, campaign related parties, either several jointly, repayable on demand or without specifying in terms of period of repayment. So government want this disclosure in the financial statement. Schedule 3 also provide the format in which the disclosure is required. So disclosure is with respect to promoter, director, claim to the related party, amount of loan or advance in the nature of outstanding, and percentage. So why this is the percentage of loan? If you see that most of the companies where frauds were happening, the sizable chunk of the amount was given by either investment or loans and advances. So by way of this percentage, you will come to know out of the total assets how much value is given to the related parties. In line with the Schedule 3 disclosure requirement, in CARO also we are required to disclose if any loans without specifying any terms or period of repayment. So here also we need to disclose. There is one more additional requirement with respect to loans and advances in the CARO reporting is the whether during the company's provided loans or provided advances in the nature of loan guarantees other than the NBFCs or companies whose principal business is loans. In such cases, the aggregate amount during the year and balance outstanding at the balance sheet date is required to be disclosed. Now, aggregate amount during the year means, suppose if you are given a loan of 10 crores and it is repaid during the year, and at the end of the year balance is zero, but such a transaction is also required to be reported for the aggregate amount paid during the year. And this bifurcation of the aggregate amount and balance sheet outstanding is between one is the related parties like the subsidiary, joint venture, and associate, and one is with respect to the other than those related parties. ICI guidance note has given some sort of format under which the reporting can be done. Now, when we are reporting loan, reporting either in Schedule 3 or CARO with respect to the loans and advances, always the disclosure is coming, or disclosure reporting is coming for the subsidiaries company. So these subsidiaries understanding can be different from the Companies Act perspective and the Index perspective. So we have to consider the definition as per the Companies Act only. Now the real questions are coming if you see the loans in the nature of, or advances in the nature of loan. This is the new. Earlier we were reporting where only for the loans, never the advance in the nature of loans were part of the reporting. Now, what is the advance in the nature of loan is depend on the circumstance in individual circumstances, where the auditor or company has to take the judgment. I will listed certain examples where we either it can be advances, pure advances mean if you are giving for the against purchase order in accordance with the trade practice would not be advanced in the nature of loans. Advances given for amount in excess of order value could be advances in the nature of loan. Where the trade practice doesn't exist, then we have to understand in the what is the realistic way. Now, in line with the banking, where the lot of evergreening is happening, the central government has proposed the additional reporting requirement under CARO. What it talks about, the report, what is required, whether any loan or advances in the nature of loan granted, which has fallen due during the year, has been renewed or extended or fresh loan granted. So during the year, if my loan is renewed and if I have my loan is due and which is renewed, or for my due loan, if further loan is given, then such things are required to be disclosed. ICA guidance notes has given the format in which it can be disclosed. Now, compliance with the two layers of the companies is the first. If the company is non-compliant with the two layers of the company, then reporting is required, and ICI guidance note has given some sort of the format in which the non-compliance with respect to two-layer companies or the where the requirement of special resolution is not met, or the loan given at the rate of interest lower than the prescribed. So all such of defaults with respect to 185, 186 is required to be reported under CARO, and it can use the format for the reporting. Now, with respect to the borrowing, this is the first time which has come in the Schedule 3, whether the company has not used the borrowing from banks and financial institutions for specific purpose for the was taken at the balance sheet date, the company should disclose the detail of which they were being used. So if we recollect in past, such of in line of 8, we used to give a disclosure in CARO. Now in same line, the company is required to disclose about the utilization of the borrowed fund, or if it is not utilized for the specific purpose, then it has to same fact need to be disclosed in the notes to accounts. There are two specific clauses which deal with the what was discussed under required to be disclosed under CARO, and the Schedule 3. Now, CARO is also required the disclosure. Whether the term loan were applied for the purpose for which the loans were obtained, if not, the amount of loans were diverted, and for the purpose for it is to be used. So in this, if you see 2016 CARO, this requirement was not there, but in earlier 2013 CARO, this requirement was there. Now the requirement has reintroduced. So we have to be very careful when we are verifying the loans taken and its utilizations. Same line, whether the fund raised on short-term basis have been utilized for long-term purpose. If yes, the nature and amount to be indicated. Willful defaulter, if you hear from last couple of years, a lot of in the public domain, we are hearing a lot of on the willful defaulters. So now the central government thought, let's come with the disclosure in the financial statement and let auditor report on the willful defaulter. What is the requirement of Schedule 3? Where a company is declared willful defaulter by any bank or financial institution or other lender, following details shall be given. One is date of declaration as a willful defaulter, details of defaults, amount and nature of default. In line with the Schedule 3 requirement, auditor is also required to report under CARO whether the company is a declared willful defaulter by a bank or financial institution or other lenders. Now here, the other lenders, we have to be very careful. Now, if you see a willful defaulter, if you see mostly is declared by either the RBI or by banks. We have never heard about the willful defaulter by the other lenders. So, but CARO 2022 required reporting of defaulter by the other lender also. So there are certain aspects which we need to consider while reporting. Is the in case of other lenders, the guidance note talks about if these other lenders are declared as a willful defaulter by government or the government authorities, then only it should be considered. One more facts which has come, or one disclosure may come if the company has received the notice of willful defaulter, but still it is not declared. Still, the guidance note suggests the company is required to declare. The company has received the show-cause notice for the willful defaulter, and accordingly, the auditor is required to report in the CARO. Undisclosed income, this has come for the first time. No doubt in income tax assessment, many of are facing or have seen the undisclosed income, but the company is this is the first time the company is required to disclose about the undisclosed income. However, the disclosure is restricted to the extent if it is surrendered or disclosed as income during the year in the tax assessment unless there is immunity for the disclosure under any scheme. Also, shall state whether the previous unrecorded income and related asset have been properly recorded in the books of account during the year. So all this, in case of undisclosed income, all such things is required.
Sir, please be a little louder.
Okay. 1 minute. Now audible?
Yes.
Thanks for confirming.
Yeah.
Yeah. So all in case of undisclosed income, the company is required to give the facts in the financial statements. The ICAI guidance notes on the Schedule 3 give the format in which the disclosure can be made. Whether the now question comes whether the addition is made by the income tax authority and company has disputed such addition reporting on the disclosure is not because generally if you see the additions made, it is already recorded in the books of accounts. So and due to the additions, if tax liability is coming, those things not required to be disclosed as the undisclosed income. Now, in line with the Schedule 3 requirements, the auditor is also required to report under CARO whether any transaction not recorded in the books of account have been surrendered or disclosed as income during the year in the tax assessment, under the Income Tax Act? If so, whether the previously unrecorded income has been properly recorded in books of account. So it's a statement of facts which has to be reported. Now, things to be considered. So even up to date of so whether undisclosed income or maybe the assessment which has come up to March 22 has to be considered, or the ones or suppose I am approving the financial statements somewhere say May, June, July, and something has come in those period also from the end of the financial year till the signing the audit report. So according to me, by way of subsequent event, we need to consider the impact of the same in the financial statement and the reporting requirement. Now, if the undisclosed income has the material impact, then the company should consider or revisit in this 8. Now, in this 8 talks about the restatement of the financial statement. CSR, I think I think in the opening remarks, our chairperson also mentioned about the additional disclosures are coming by way of the Schedule 3. With the just for the sake of benefit, I will just read it. What are the disclosure is required? Amount required to be spent by the company during the year, amount of expenditure incurred. I think this we were already disclosing in the notes to accounts. Shortfall at the end of the year, we will be already disclosing. Now, total of previous year shortfall. Now, this has come for the first time because of the changes in the section 135, which talks about the carry forward. So now for first time, we have to disclose about the total of previous year shortfall, reason of shortfall, nature of CSR activities. Now, details of related party transaction, example, contribution to a trust controlled by the company in relation to CSR. This has come for first time since majority of cases, CSR funds are diverted by way of through a related party. So now the central government thought, let's have a disclosure if my CSR funds are routed to a related party. Whether provision is made with respect to the liability incurred by entering into a contractual obligation, the movement in the provision during the year should be shown separately. Okay. Now, auditor's responsibility is also there to report in CARO, but responsibility is only to the extent of the they bifurcate between ongoing project and other than ongoing project. So in case of other than ongoing project, the auditor has to report whether the unspent amount is transferred to funds within a period of 6 months or not from the expiry of 6 months from the expiry of the financial year. So reporting is very restricted to the extent of whether funds is transferred or not. And in case of the ongoing project also, the unspent amount is required to be transferred within 30 days. So only a limited reporting is there compared to the disclosure which is there in the Schedule 3. Some sort of format is given for reporting both for the ongoing project and other than ongoing project. We can use this format for the reporting purpose. Now, this has come for the first time. If you see the list, majority of companies may be disclosing ratios either in the director's report, or if you see the date listed company, some sort of ratios are required under the SEBI regulations. Now, company is required to disclose all these current ratio, debt equity ratio, debt service ratio, return on equity ratio, inventory turnover ratio, trade receivable ratio, trade payable ratio, net capital ratio, net profit return, all this ratio in the financial statement. Now, this ratio is required to be disclosed by the company who are following the division 1 or division 2. There are separate set of ratios to be disclosed by the companies who are following division 3, like some mistake is there. I think it is not a current ratio. It is the tier 1, tier 2 related disclosures are there. So whenever they are disclosing the ratios, the company shall explain the item including numerator and denominator for computing the above. So you have to, in detail, you have to give what is your numerator, what is the denominator. Further, if there is a variation of more than 25%, either positive or negative, then the reason of the same need to be disclosed in the financial statement why there is a revision. Further, we have to consider one more thing. In a if say in a particular year, say I am closing March 22, I am getting good favorable ratios, but by following the same formula, I am in the March 23. We will have some negative impact. So can I change the either denominator or the numerator of the formula? The answer is no, because whatever you followed for March 22 or March 23, sorry, March 22 has to be followed in subsequent period. One more trigger point is there, whatever we are discussing now, henceforth. Now, when you talk about the ratio disclosure, this has come for the March 22 for first time. But at the same time, the company is required to disclose for the March 21 for the prior period also. On the basis of ratios, there is a reporting requirement in CARO. So, on the basis of financial ratio, aging and expected dates of realization of financial assets and payment of financial liability, other information accompanying the financial statement, the auditor knowledge of board and director management plan, whether the auditor is of the opinion that no material uncertainty exists at the date of the audit report. Now we have to give there is no material uncertainty. Ideally, if you see wherever the question of going concern is there, we used to consider those issues by way of SA 570, and we used to report under the main report. Now here, even if the company is not facing the going concern issue or non-material uncertainty exists, still we have to give the positive report. There is no material uncertainty exists. So this is the additional responsibility cast on the auditors. Now we move to the key changes in Schedule 3, which for which there are no corresponding changes in the CARO. I will just rush little fast because it's very simple. Earlier, if you see rounding, it's with respect to rounding off. Earlier, rounding off was optional. Now, rounding off is become a mandatory. Whether the division 1, division 2, or division 3, all companies has to round off. Whether a small size company, big size company, or a one-person company, there is no exemption provided. Second, earlier the rounding off criteria was based on the turnover. Now for the March 22 onwards, the rounding off criteria would be on the total income instead of the turnover. Now, aging schedule. Now, while doing the audit, definitely all of us would have gone through the aging schedule. Now, what the information we used to have in our audit file now will come as by way of a disclosure, maybe of enhanced disclosure either in the Schedule 3 and according Schedule 3. So there is no corresponding reporting requirement. So what it talks about, if as on the balance sheet date, if we are having the capital work in progress or intangible under development, so company is required to disclose the amount spent till date in the aging buckets, like the less than 1 year, 1 to 2 years, 2 to 3 years, more than 3 years. So it is with respect to the project in progress or the project temporarily suspended. Now it is not required to be disclosed only for the current March 22, and same exercise the company is required to do for the March 21 also. Now, for the CWIP and the intangible asset under development, there is one more additional requirement in case the project is overdue. or has exceeded its cost. So what is the reporting requirement under Schedule 3? So what it says, when you are going to complete in future, so give us the realistic date. You are going from the end of the year, whether you are going to complete the project within 1 year or 1 to 2 year, 2 to 3 year, or more than 3 years. So realistic picture has to be given. Definitely, it's based on it has to be given by the management, and the auditor rely on such data on the management representation. Now the issue is in case of the project which are suspended, same sort of information is required, and that is also the project-wide details are required. Again, the disclosure of comparative figures. So whenever we will discuss it in future for the subsequent slides, the comparatives will definitely come in picture, and the company is required to compare the data of the past years also. While doing the audit, or while preparing, or the company has faced the specific issues with respect to the compilation of data, because now this has come for the March 22. Now there may be a certain ERP system which are not generating the required aging analysis. So again, possibly we have to do manual activities. The ERP will not give, still the time you give the programming, the details regarding the ongoing or suspended details. So ultimately it's the manually we have to work out. Third thing is the original estimation of project cost versus the revision of estimation of project cost. The reporting is required based on the original estimation of project cost, because in past slides we discuss about the overrun. Now, in case of overrun, if the expenses are increasing because of the delay in the project, so the comparison has to be given with respect to the original cost. When temporary suspension is a necessary part of the process of getting an asset ready for its intended use, the project should not be considered to have been temporarily suspended, and CWA related to such projects should continue to be presented as a project in progress. Now, when the project is temporarily suspended at the end of the reporting period, but development of the same resume after the end of reporting period, then aging of its related. So this sort of some sort of a clarification has come, or you can use the clarification while deciding on the certain aspects. This is point number 8 will give a little bit problem, because guidance note talks about the CWIP shall be applicable for investment property under the developments. So we have to really think about it, whether or assess whether the information is required or not, because the guidance note is by way of guidance note specifying the company is required to give such a disclosures. Now, with respect to the aging of a trade payable, as we discussed for the CWIP and or intangible assets, the aging analysis of the trade payable in the various bucket is required to be given, and in addition to that, the bucket has to be bifurcated between the MSME, others, disputed MSME, and disputed dues others. So if you see, if I'm giving any information in this bucket, then this figure should match with what the amount is reflected on the face of the financial statement. There may be a case where the amount is not matching because of the unbilled dues or billed not due. Because here the aging is required only if the bill is due. There may be cases where you have received the material, but the payment is not due. So in addition to the aging analysis, we need to give the separate columns for the unbilled dues, bill not due. So all in totality will match with the what amounts are reported on the face of the financial statement. Now, problem is, if you see here the aging is required with respect to the micro, small, and medium enterprise. So all the three categories. Whereas on the face of the financial statement, only the reporting is required for the micro and small. So possibly this require additional one reconciliation. So this also need to be kept in mind. Now question comes, what is a dispute? So generally in legal, in the normal understanding, dispute means either there should be a legal notice. However, if you refer to the guidance note, it says dispute means a disagreement between the two parties demonstrated by some positive evidence with support of corporate effect. So there may be an exchange of emails, or there may be exchange of letters where they disagree or with the certain things. So those things also can be considered as the disputed. Now, main problem just I think missed out is the when you are coming to aging where more than 2 to 3 years and more than 3 years reporting is done, the questions will come on the why the amount is not paid. So so auditor is required to verify this detail a little bit in depth, because once we say my liability is coming from 2 to 3 years, 1 to 2 years, and vendor is not asking for the questions, then definitely there would be a question on the original transaction itself. So please be careful when anything is reported under more than 1 year and the vendor is not demanding a payment. So additional audit procedure would be required to justify or to satisfy the auditor the aging is done properly. In line with the trade payables, there is a disclosure for the trade receivable. However, there is a division 1 required a separate disclosure compared to the division 2 and 3. In case of division 1, if you see a bracket, the time bracket, so in trade payable, it has started from less than 1 year. Now this less than 1 year for the trade receivable is further bifurcated between less than 6 months and more than 6 months to 1 year. So what is required is the considered good, considered doubtful in case of the undisputed. In case of disputed also, considered good and considered doubtful is required to be disclosed. Same thing with respect to unbilled dues and bill not due. So it's required a separate columns so that the figures disclosed on the face of the financial match with the aging analysis. Now for division 2 and division 3, in addition to considered good, additional line item where the disclosure is required, where the data has a significant increase in the credit risk and there is a credit impairment. So both is in case of undisputed also, in case of disputed, this additional requirement is there with respect to the index companies. Now this has come for the first time. Now company is required to disclose the promoter shareholding in the financial statements. Earlier there was no specific requirement. Now amendment talks about the in financial statement promoter name, number of shares held, percentage of total share, percent of change during the year. Details shall be given separate for each class of assets. So if you see for equity shareholder, we are giving the information for the less more than the 5%. Now for the promoters, even if you are holding shares holding is less than 5%, still the reporting is required. Now those who are doing these listed entities would be aware about the criteria of the promoter and promoter group is already there. Their company is required to intimate to the stock exchanges what is the promoter and promoters group. However, the reporting under Schedule 3 is restricted only to the extent of promoter, and promoter group is not part of the reporting requirement. The questions will come, who is the promoter? So we have to go to the section 269. Now, according to 269 of the Companies Act, who has been named as the as such in the prospectus or identify the company in the annual return, or who has a control over the affairs of the company directly or indirectly. The third is in accordance with the which advice instrument board of directors are performing. So section 2 subsection 69 will give the a little bit information who can be considered as a promoter. For the sake of the time, I will just skip because some changes on the face of the balance sheet which we can understand. Only the separate disclosure for lease liabilities are there. Now, in case of equity share capital, there is additional changes come where the company is required to disclose the changes in equity share capital due to the prior period errors, and accordingly they have to restate the balance at the opening. So this is the additional disclosure requirement has come, and this thing is required for the both the years, current year and past years, wherever applicable. Statement of changes. If you see in the financial statement, generally we give the disclosure of all the reserves or some sort of narratives are given. Now the changes or amendment has brought suggested that only in case of other reserves you should give such explanations. It's just change in the disclosures. Here also the change in the disclosure, so we'll not be discussing in detail. Now this has come for the first time, relationship with the stock of companies. So what Schedule 3 requires is if you have a transaction with the companies which are struck off under about 248, so you have to the company is required to disclose whether the company is having investment in securities with those companies, or receivable, payable, or shares held by stock of company, other outstanding balance. It's really a tedious job because the details of the stock of company is not, or the compilation of stock of company is not available. Each and every registrar or ROC offices are having their own list, and which is available in the mostly in the PDF format. So really to report under this clause, it's really a challenging job for all the companies, and the questions will come on what basis auditor would have verified all such amount reported for the stock of companies. There is one more disclosure which has come for the registration of charge. So if the company has delayed in the creation of charge or the service of the charge, then this disclosure will trigger. And when it is triggering, so the company is required to disclose, shall provide the details in relation to each charge or satisfaction. So here there would be we have to give for each charge if there is a deviation, and for each charge a brief description of the charge or satisfaction, or pertaining to the which location of registrar, the period of delay by which such charge had to be registered, and the reason for delay in the registration. So you have to give the reason for delay in the registration also. Cryptocurrency is talk of the town. I think there is a lot of questions on the legality aspect still. Under Schedule 3, the company is required to report on the cryptocurrency and the virtual currency where the company has traded. In case where the company has traded or invested in cryptocurrency or virtual currency during the financial, the following shall be disclosed. Either one is the profit and loss, second is the what is the balance as at the reporting date, and deposit or advance received from any person for such purpose. Okay. We'll deal with the changes in the CARO. Now the remuneration related clause is deleted. I will summarize the what are the new clauses. There are some clauses in borrowing. In case of borrowing, if you see the clause 9C, amount of loans were diverted and the purpose for it is used, short-term leases have been utilized, I think, which we have discussed in the earlier slide also. Whether the company has taken funds from any entity or person on account of or to meet the obligation of subsidiary. This is the first time reporting is come. In case any sort of loan is taken to fulfill the obligation of the subsidiaries associated with JVs. 9F, where the company is raised loan during the year on the pledge of security held in the subsidiaries, joint venture or associate company. If so, give the details thereof, and also report of the company has defaulted. So this is also is coming for the first time, or there will be changes. This is fraud reporting by the auditor. I think some sort of reference I have given when we were discussing about in the inventories. Once auditor is of the opinion there are some frauds are committed by the company, then there is a responsibility on auditor to report under section 143 subsection 12 by in the ADT 4 to the with the central government. Whistleblower, this reporting has come for the first time. So where the auditor has considered whistleblower complaint, if any. So how we get the whether any whistleblower complaints are there or not. So ultimately you have to rely on the management representation whether they received any whistleblower complaint or not. I have listed out the entities or to whom the whistleblower is applicable. There are some changes in reporting changes in the Nidhi company in case of where there has been any default in payment of interest or deposit or repayment of thereof for any period, and if so, the details thereof. Internal audit has come back. If you see 2016, there was no reporting required for internal audit or audit perspective. Now it has come back. Now reporting with respect to NBFC or HFC or CIC. If you remember, if you recollect, as on date, we are reporting on whether the company has the NBFC license, NBFC certificate from ROC, and accordingly we used to give the positive comment wherever it's applicable. Now, in addition to that, there is an additional reporting requirement for the NBFC or HFC or CIC. First one is where the company has conducted any non-banking financial or housing finance activities without a valid certificate of practice. So some activities are carried out without the valid certificate of registration. Reporting is required, but in my opinion, only we should, in such cases, we should not restrict to the extent of the CARO. If the material deviations are there, then you can consider the modified opinion by way of SA 705. Whether the company is a core investment company as defined in the regulations made by the Reserve Bank of India. If so, whether it continues to fulfill the such criteria. So this is the factual things. And last one is whether the group has more than one CIC as a part of the group. So we have to ultimately rely on the group structure and rely on the management and representatives, whether any other CIC companies there in the group or not. Cash losses, it was not there in 2016, it has come back. Now, resignation of statutory auditor, I think, which we were just pointed out in some time back. So wherever there is a resignation of statutory auditor during the year, as a new incoming auditor has to take under consideration the issues, objections or concerns raised by the outgoing auditors. So this is the new reporting requirement, because if you, in a few years back, if you see, there was the series of resignation by the auditor for the various reasons. Now here, central government wants the new incoming auditor should understand what was the reason of resignation, and accordingly he has to plan his audit, or some sort of the facts are required reporting, then accordingly you should consider reporting. Some of the facts about the resignation of auditor is we need to understand there is a SEBI circular which deals with the resignation of the auditor in case of the listed entities and its material subsidiaries. The ICAI also has issued the implementation guide on the resignation and withdrawal of the auditor from the engagement. New incoming auditor should comply with the appointment formalities under the Companies Act. Just I would like to share my practical aspects with respect to the IBC companies here. So what is happening in the IBC companies now? Due to resignation of auditor, casual vacancies are created, and new auditors are appointed. But again, these new auditors appointment is required to be confirmed by holding the AGM or EGMs. But some of the cases which has come in our knowledge is without holding an EGM or AGMs, those auditor was appointed by way of casual vacancy are holding the position. Please be careful about such non-compliances. One more thing is the ICAI Code of Ethics required communication with the retiring auditor. Possibly when you communicate with the retiring auditor, they may give or may not give the reason for their resignations. And if they give in the writing what are the reason for the resignation, you have to consider while conducting the audit. Last one is with respect to CARO of the companies considering the consolidation. Now here only when we are doing the consolidation, and if the statutory auditor of the either subsidiaries or JVs or associate had given any sort of remarks or qualification, then in the reports we have to give which is the entity and what are the para reference and which entity has given the negative remarks. We'll deal with the just maintenance of records with related to intangible assets, which has come earlier. We used to give only for the property fixed asset, which is property, plant, equipment, and we also give a report need to report on the maintenance of records with respect to the intangible assets. Now, intangible data has its own challenges. Compilation of data for intangible assets is very difficult because what the details is available is with respect to the either expenses or capitalization of the individual basis. So in collectively, when you talk about asset, possibly the data would not be available and required to be compiled. Physical verification of inventories, it's again there's some changes. Earlier we used to report on the material discrepancies. Now they've come out with a certain threshold limit of 10%, and if 10% or more, then we have to report. Now the 10% of more has to be with respect to the each class of inventory. Now we cannot aggregate and say 10%. If in individual class of category there is a deviation of 10%, then reporting is required. Punit bhai, how much time we have, or we already exceeded?
Yes, sir.
We can conclude how you want to.
No, I think if there are not few slides, then you may just complete the task, and in brief, we may be able to complete that.
Now, what are the amendments in CARO which we are discussing? These are the existing clauses where the certain sort of the amendments are made. Again, is with respect to the advance in the nature of loan, not much. Clause 3C, there is not much changes. Now here, in case of deposits, earlier there was no specific inclusion of the deemed deposit, but now by way of amendment, the deemed deposits are included for the reporting purpose. Now for statutory dues, this goods and service tax was not there. Now we have to consider the goods and service tax. Now in part B, in case of the disputed dues, we were the reporting was very restricted to the income tax, sales tax and others. Now what they say is whatever you reported earlier in para A should be considered for the reporting under the disputed. Now this is a big change in the, it's would say big change, there is a change in the reporting requirement. Earlier, in case of default, we used to give the default in case of the financial institution, banks or government or debenture holder. Now we are required to give the default in case in all cases. So in case of any lender, if there is a default, the reporting would be triggered, and accordingly we need to, auditor is required to report under the CARO. Now in case of fraud, earlier the reporting was restricted to the extent of the fraud committed by its officer or employees. Now this has been deleted and now the scope has been widened. Just I will take 10 minutes and if you see, there is a, with respect to the movement of fund, specifically utilization of borrowed fund and share premium or advance or loan for the loan or investment purpose, there is a specific disclosure requirement under the Schedule 3 and there is a specific disclosure requirement in the report. So if you refer the change in the main report, now in change in the main report deals with the 3-4 items. One is the part rule 11D, which deals with the note related disclosure, which has been deleted. Now 11E1 and 11.2 is the new reporting requirement under the main report. Now we'll just give time. I will just discuss in little bit detail what is the reporting requirement. Now, whether the management has represented that to the best of its knowledge and belief, other than disclosed in the notes to accounts, no fund have been advanced or loan or invested either from borrowed fund, share premium or any other source or kind of funds by the company to or in any other person or entities, including foreign entities, with the understanding, whether recorded in the writing or otherwise, that the intermediary shall, whether directly or indirectly, lend or invest in other person or entities identified in a manner whatsoever for it. So, in nutshell, what is saying, if a company is borrowing funds and it is giving to an intermediary company or the entities. So with the instruction, this fund ultimate should go to the ultimate beneficiary. If this sort of transactions are there, then it has to be disclosed in the notes to accounts. Same way, the reporting is there with respect to the intermediary company. If the intermediary company is receiving the funds, and with the instruction of the giver of the fund is giving this fund to the ultimate beneficiary, the reporting requirement will come here. So these two are the new reporting requirement. Please ensure that the proper care is taken while reporting under these clauses. For the sake of the time, I'm not discussing on the examples which is given there. Schedule, there is one more additional disclosure requirement by Schedule 3. So when company is giving fund to an intermediary company and when intermediary company is giving to the ultimate beneficial company, in the financial statement of the company who is giving the loan, they have to disclose the date and amount of funds further advance or loan or invested by such intermediaries to the other intermediary or ultimate beneficiary. This disclosure will definitely will have some challenging, because as the auditor, you would not be having access to the accounts of those intermediary, and the question will come on how the data is compiled and how the data is reported. Further, as an auditor, we have to ensure that the not company and auditor both, such transactions are in compliance with the Foreign Exchange Management Act and the Prevention of Money Laundering Act. Part 3, on the basis of earlier two reporting requirement, the auditor has to state whether based on such audit procedure, the auditor has considered reasonable and appropriate circumstances, nothing has come to their notice that has caused them to believe that the representation under clause 1 and 2 contain any. So we cannot rely on the management representation for the reporting under clause E1 and 2. We have to do a testing, and after testing we have to conclude on the reporting aspects. There was one more reporting requirement under clause F is the whether dividend declared or paid during the year by the company is in compliance with section 123 of the Companies Act. So these disclosures will be with respect when we are reporting for March 22, possibly we have to consider the final dividend proposed of the last year, also interim dividend and final dividend proposed by the board and subject to approval. All these three reporting requirement, all three aspects need to be considered for the reporting purpose. So ultimately, for all the changes which is made by either in Companies Act or the Schedule 3 or CARO, the ICI has come out with this pronouncement, which is very useful for the understanding purpose. Division 1, Division 2, Division 3 guidance note is available, or on guidance note on CARO report is available. On there is implementation guide is available, which is very useful for the reporting purpose. Yeah. Thanks. Conclude it.
Yes, sir. Exhaustive.
Yeah, 1 minute.
Sir, I must salute you for the immense knowledge and the in-depth detail by which you have taken the today's session. So may I request all the participants to please join hands with a round of applause for the exhaustive work that Timal Bhai has done and presented over this entire 2 hours session. Okay, almost 2 hours it has been there, and while speaking it has become 2 hours. And friends, for preparing, he must have taken, I think, days together for making this presentation. And while we are little bit relaxed कि okay आएगा जब देखेंगे, now this company's rules are very much there in front of us, and Timal Bhai has taken us through the entire gamut of the changes, whether it is small changes, changes related to small company or changes related to listed companies. Timal Bhai has covered almost all the examples, and I am thankful on behalf of Jain Chartered Accountant Federation as well as entire participants who are here together. Timal Bhai, please accept a hearty vote of thanks from my side, and on behalf of JCAF, let me just also share.
Thank you.
So, friends, this is something that we are proudly presenting it to CA Timal Bhai, and thank you very much, Timal Bhai, once again.
Thank you very much, sir. Thanks for giving the opportunity for sharing my thoughts.
Yes, sir. Sir, it was a real pleasure of hosting you, and it was wonderful for all the participants. In fact, they have requested for this presentation, this exhaustive presentation. There, I've got multiple requests of these presentation. So, if by your permit, can I share?
Yeah, definitely.
Okay. So
it's for sharing only.
Okay. I will share it 1 second.
only in the ratios you have to update, or I should send the updated because there was some mistake for the division 3.
It is not downloadable on my laptop as of now. If you can share it right away, do it. Otherwise, participants, I will send it as an email to all the participants. I have all the list of this thing. I will share it with all the participants today.
Okay, yeah. Whatever little changes was there, I will make it and I will share with you.
Yeah, fantastic. Right.
Yeah, thanks.
Yes. And thank you very much once again, Timal bhai, and thank you all the participants. I can see Tarachan Bafna, our mentor and director at JCAF, Ashok bhai, Girish bhai Maru, Kamlesh bhai, Nand Kumar Khandilwal, Padam bhai, Vikas ji, Rajesh ji, everyone. Thank you for attending this session, and please keep updated. We will be back with a new session this Friday. Thank you. Thank you very much.
Thank you.
I'm ending the session.